The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
A very warm welcome to Scorebox with myself, Steve Sedgwick, and Carolyn Roth, and these are your headlines. So Asian equities taking a leg down after a choppy session on Wall Street, as Fed officials say they will need more information on Trump's policies and the inflation outlook before delivering another rate cut. President Trump escalates his criticism of Volodomyr Zelenskyy, accusing the Ukrainian leader of duping the former US administration and misusing military aid.
A dictator without elections. Zelenskyy better move fast or he's not going to have a country left. Got to move fast because that war is going in the wrong direction.
Airbus beats on quarterly net profit and sets a higher full-year delivery target despite troubles in its supply chain. We will be speaking with the plane maker CEO Guillaume Faury at 10:15 GMT. Germany's two main candidates face off in the final debate ahead of Sunday's elections, with polls putting the conservative frontrunner Friedrich Merz in a strong position.
Well, Mr. Chancellor, no miracle will happen over the next 4 days. Your chancellorship should be over on Sunday.
I'm not campaigning for a miracle, but for a democratic election in which the outcome will be different from what you are making it to be.
We have a stunningly packed day of corporate reporting, and that is going to be the mantra throughout the show, talking to, 8, 9, 10 CEOs as well. Go straight into Renault figures as well, if I may. Charlotte's waiting by in Paris as well. The shares, they've had a huge rally off their 5-year low, and yet still only trade at 4.8 times forward. Look at that, 40% rally 1 year. What about the numbers? Well, sales, 56.23 billion euros. That is beating expectations of 54.45. Operating margin, 4.26 billion. That is better than the expected, albeit company compiled consensus of 4.22. Free cash flow, always important for the automakers, 2.88 billion euros as well. The outlook, group operating margin seen circa or above 7%. Includes around 1 point of estimated CAFE negative impact, those emissions rules as well. They are proposing a dividend to reflect confidence in the group's future prospects, according to the CFO. Let's get to Charlotte, who's been poring over these numbers as well. Charlotte, the stock has come an enormous way. Still cheap compared to broader indices, according to some, but maybe a value trap, according to others.
Yes, but yet we've seen this recovery in those shares that are performing extremely well. And when you compare to some of its competitors, this is one of the success stories that we've seen in Europe when it comes to the autos industry. And you can argue, of course, that Renault is not exposed to China or is not exposed to the US. So you don't have the concerns of the slowdown in demand in one or tariffs in the other. But they are exposed to the slowdown in demand in Europe. And certainly they still have been performing quite well. And one of the final elements that we saw is that in December, they had a bigger market share than Stellantis for the first time, and they have been doing that thanks to 10 new launches in 2024. They're looking at launching 7 more new models in 25, and some of these models are like the Renault R5, the R5, which is a very iconic old model that they revamped in a full electric version, and they are under 25,000 euros, and that is the key there. They try to push out to the market some cheaper EVs to try and attract some of the buyers there, and that's one of the key things they have been doing. Those had a good success with their brand Dasha, kind of a more low-cost brand that is part of the group, and they have some very successful SUVs there that also have been good for demand there at Renault. So, that's been part of the strategy under Luca De Meo, who joined in the summer of 2020, had this whole new strategy, moving very much away from the Carlos Ghosns. That was all about volumes, and here now the new strategy is all about margins. Of course, the hybrid and EV cars are more expensive, and so there's some margins, but also very expensive to make, but they have been successful in doing so. And here again, they say when the question of incentive being pulled away, that's making things difficult for the EV car makers here in Europe. And there's a question of, the tariffs that we put now on Chinese EVs coming into the market. That has been a positive for them, but it's difficult. They have some very tough targets coming in, some new targets coming into 2025. A lot of them are worried about having to pay some fines as well. So going back to Renault and some of their numbers, they have done better than expected in 24. In terms of the targets they have for 25, they see a free cash flow at least above 2 billion euros. It was above 2.5 billion in 24, and operating margin equal or above 7%. Here again, a little bit lower than they had for this year. But here again, they know that it is a difficult context, and there were some quotes by the CEO, Luca De Meo, recently said, look, we are doing our transitions to EVs. It's costing us a lot of money, but we can't force demand. The buyers at the moment are just not there. But they hope, and a lot of analysts say that they hope that in 25 there will be some demand coming back on the market. But certainly it has been challenging for a lot of these automakers, and Renault is one of the success stories because, of course, they come from great difficulties after the Carlos Ghosn years, after the pandemic. But the new strategy under the new CEO has been successful, and that has been very much reflected in the share price over the past year.
All right. Thank you so much for that. And of course, Charlotte will be speaking to Luca De Meo, the CEO of Renault. That's coming up today at 9:30 GMT. And of course, that is a CNBC exclusive. Thank you so much for that, Charlotte. And Steve, I've been poring over numbers from Mercedes-Benz, the luxury car maker out of Germany, and it's dealing with a lot right now. It's dealing with tariffs from the US. It's dealing with overcapacity in China, of course, weak demand in China. And it just came out with its numbers. Earnings down 40% in the car division in 2024. Take a look at the share price, off by almost 9% of the course of last year. The group doesn't just report earnings today, it's also its capital markets day, and we're waiting for new guidance for the year 2025 and 2026. And what it's saying here, and I'll stop there and toss it over to Annette, but one final point from me. It expects significantly lower earnings in 2025 for the group as it works through boosting competitiveness and cutting costs. Annette, what's your first gauge here?
Yes, actually, it's a fair summary what you've already done, Caroline. And if you look at the numbers, they are more or less in line because analysts had expected quite a bad result for the fourth quarter. That is what was reflected here now in the full year numbers. What I thought is perhaps standing out is that the liquidity position of the company, though, is quite good. So liquidity has even risen to 31.4 billion euro at the end of the year. And that gives them ample ammunition actually to weather that restructuring program they are most likely facing for 2025 and perhaps also 2026. So more we'll get to know from them during their capital markets day. But one thing is sure, they are actually U-turning on their electrified vehicle strategy, and they're bringing more than 10 new models on the market, which are closer to the look of the combustion engines, because what they've done in the past, they came up with like these super designed electrified vehicles, but clients didn't like that. And so they actually stayed on the shelves, so to say. So that is the big hope of Mercedes, that they are able to turn around customer demand also for electrified vehicles, but of course not as fast as previously expected. Analysts are quite critical of the luxury-only strategy of Ola Källenius and his team, so remains to be seen whether we'll see some tweaking of that strategy. And the return on sales for this year is they are targeting a return on sales of roughly 8%, and that the previous target, the luxury strategy target, was 14%. So I think the market will very, very much look as to what that means for the medium term horizon, whether they will reduce that target substantially.
All right, Annette, thank you very much indeed for that. And we'll catch up with you a little bit later on as well. Right, let's move on to the insurance sector. Looking at NN Group's, the financial services and pensions insurance group as well. The OCG, it's a key measure for them, operating capital generation. for 2024 reached more than 1.9 billion euros. That is reaching their 2025 target a year ahead of plan. They are saying they've got excellent commercial momentum. I want to get straight to David Knieber, who is the CEO of NN Group. David, it looks incredibly positive. Why have we got to wait till May for these upgraded targets, sir?
Good morning. No, indeed, we had very strong results over last year. Not just the 1.9 billion that was achieved a year ahead of plan, but also the commercial results. Our value new business grew with 20%. We had 2.3 billion of inflow in our DC, our defined contribution pension business, and our non-life business grew with around 4.5%. So that means that, and we've seen this over time, that we become less dependent on financial markets and spread business, as we call it, and we increase the amount of capital generation that comes out of underwriting and out of fee business, which is overall a good trend. But indeed, today we're reporting the 2024 results, and it's a good reason to follow our Capital Markets Day that will come in May, where we also come out with new targets after 2025.
Yeah, you're teasing us about the Capital Markets Day. We'll talk to you then as well, David, of course, hopefully. But the combined ratio down to 93.1 as well. You talked about fee generation. I just want to know what the catalysts there are for better fee generation, better premiums. It's a hard market rather than a soft market, I understand as well. Is that combined ratio going in a southerly direction? Is there more profitability to come from here?
Right, so we set a guidance of between 91 and 93. It's clear that the non-life business continues to do well. We saw our property and casualty business with a combined ratio of 91.9. We're very resilient around managing this book. Clearly, the motor portfolio is always something to watch. So we have been also increasing premiums where needed. The fire book has been doing well, so there we can be a bit more muted in terms of managing this book. But we continue to be very committed to the 91 to 93, and I think the good news is that we've not only been there for several years now in that range, but also the business is growing. I mentioned that the overall premium grew 4.5%. So we're combining a healthy profit margin also with a growth of the business, and it led to a very strong operating capital generation for the non-life business. So that's overall a positive that we also expect to be able to continue.
David, this is Carolyn jumping in. Good morning to you, and congratulations on the numbers. You've long made the point that one of the key drivers for your business is the lack of penetration in terms of insurance products across Europe, specifically also Eastern Europe. With the rise in geopolitical tensions, do you expect that demand to only increase going forward?
Yes, indeed. Good morning, Caroline. Yeah, the European business has been consistently growing. I mean, if you go back to around 2020, it was around 250 million. We're now at 461, so the business almost doubled since that period, and that has really been on the back of this under protection that we see in these European markets. And yeah, with all the increasing uncertainty, that's typically a reason that customers start to even think about more about how well they are protected. And governments have been struggling to provide that protection. Employers are not always willing to do this. So that means that individuals have to step up. And so I think it's partly under protection. I think the other part is distribution. You need to be able to talk to the customer because most people don't wake up and start buying protection products. And we've been heavily investing in our tied agent channel. 38% of our sales actually comes through the tied agent channel. It's a lot of AI tooling now. We used to say, these tied agents channels was like an art, but it's really a science now. It's very data-driven on how we manage the agent to the right customer at the right moment. And that has led to actually the tied agent channel being our largest channel in Europe. So I think it's a combination of under protection, but also having a very strong distribution platform that enables us to continue to show growth. And also for the coming years, I expect that the European business can continue to grow as it has been doing.
David, I need to talk to you about a rule which is called the Danish Compromise, and you've been pretty vocal here in terms of your criticism of that. And basically, that revolves around banks being able to lower the regulatory capital if they buy asset management arms. And you've been very critical of that. Why? And are the regulators that you're talking to, are they listening to your concerns?
Yeah, I think it's. Obviously, this is not just me. I think it's a broader concern that we have in the insurance industry, and it actually goes both ways. We see on the one hand that the Danish Compromise facilitates that it's from a capital point of view relatively attractive for banks to acquire insurance or asset management businesses. At the same time, we see that under Solvency II in Europe, it's actually not that attractive from a capital point of view in the current situation how banks are being consolidated into insurance companies. So for us, this feels like that this is not a level playing field, and this is also what we have been debating with and talking to on regulators, and we'll continue to address that point. Obviously, I can't say anything on the progress there, but this is a point that we'll continue to make because we do feel that there needs to be a good level playing field when you're talking about between insurance and banking.
Hang on, David. I thought it's like Back to the Future. I thought bank assurance was tried and failed many years ago. We'll have to have that conversation another time. David, nice to see you. You're a busy man. We appreciate it. Thank you, sir, for your time today. David Knieber, who is the CEO of NN Group. Caro.
Still coming up on the show, tensions rise between U.S. President Donald Trump and Ukrainian President Volodomyr Zelenskyy. We'll break down this story later this hour. Plus, we've got a bumper earnings day on deck. We'll speak to the CEOs of Aegon, Zurich Insurance, Schneider Electric, and many more to discuss their latest numbers. And do not miss our exclusive interview with Euronext CEO Stefan Bujna. That's coming up at 7:30 London time. Minutes from the Fed's January meeting show officials waiting for more detail on the inflation outlook before lowering interest rates further. Policymakers expressed concern that tariff and immigration policy from the Trump administration could pose an upside risk to inflation and said their current policy levels allows the central bank time to assess the evolving outlook. Quick check of the U.S. markets, very much shrugging off these FOMC minutes, along with the latest tariff news. The Dow Jones up by 0.2%, the S&P 500 at another record high, but it doesn't take much these days, does it? And the NASDAQ comp up by just a smidgen. Today we get numbers from Walmart, and that will give us a much better indication of how the U.S. consumer is faring. Treasuries didn't move much. We did see some softening here when it came to the yield picture. The long and 10-year Treasury sitting at 4.511%. When it comes to the Asian trading session, we're still seeing the hangover from the tariff announcement, specifically visible in the Nikkei 225, down by 1.35%. The auto stocks still under pressure. The Hang Seng also down by 1%. The Shanghai comp pretty much flat. Now, opening calls for Europe are suggesting some upside at the start of the trading session. The FTSE 100 seen up by 14 points. The CAC 40 in Paris seen higher to the tune of 17 points. The FTSE MIB up by 40. 70 points is the upside we're expecting for the DAX. Keep in mind, though, that yesterday the Stock 600 was off by 0.8%. That was its biggest daily drop since the start of the year, responding to the latest tariff news on a number of sectors, including autos, pharma, chips. Of course, auto sector down 1.5%, Steve.
Thanks, Cara. Right, insurer Aegon has posted an operating result of €776 million for the second half of 2024. That is up 14% on the year. The company proposed a final divvy of 19 cents per share. That's up nearly a fifth compared with 2023. Lard Friese is the CEO of Aegon. And Lard, I'm trying to pour through the 34 pages of your report. Why don't you do me and the viewers a favour and tell us about the highlights and where the areas of concern are, sir?
Yeah, good morning. Good morning, Carolyn and Steve, and thanks for having me back on the show. Today we are pleased to report a solid set of results for the second half of the year, which is finishing actually a very strong year for the group overall. Our operating capital generation came in slightly higher than the increased guidance that we gave in the course of the second half of the year, which is good. Our free cash flow came in slightly higher than what we had set ourselves out for this year. And I would say the capital positions of the companies are in a good place. The commercial results are showing some strong spots, but also some softer spots in some areas. But overall, I would say we're making good progress with the transformation of Aegon, and it was a strong year, 2024.
Yeah, let me, if I may, Lard, focus on a couple of the softer spots and go into a bit more detail. International business saw 15% lower new life sales. This is a China story again, isn't it?
Yeah, it is. I mean, in China, we're seeing a subdued economic environment, obviously, and interest rates have come down quite a bit in the third, specifically in the fourth quarter of the year, which has, of course, made sure that we all repriced our products. And that, of course, has an impact on sales. Now, what is important to note is that in our international businesses, we do see our overall book of business growing. In Brazil, we are growing our overall book of business, for instance, by 17%. And the same goes for the other markets. So while China was weighing with lower sales, there are some good spots in the international business as well.
Lord, just one more question for me on China as well. I've just finished a book looking at domestic China and the consumer, and as you know better than I do, the Chinese are saving at unbelievable rates. 40-odd% of their salaries are going into savings. Why aren't they spending more of that on new life sales?
Well, what we, in China obviously is trying to turn its economy from an export-led economy to a more, to trying to push for more consumer demand. That's quite difficult, as we all know, in China. We have two companies in China. One is actually an asset management company, and there we see the benefit of people willing to invest more and save longer. And that business has been doing very well, which shows up in our results under the asset management column, which has been able to attract 14 billion in total for the asset manager in new flows. And also China contributed quite a bit for that. On the life insurance side, as I said, this is really where we have to adapt to a different rate environment. The entire life insurance industry has to. And as a result, compared to other ways to save money, they become slightly less attractive. And that's what you're seeing in the lower life sales.
Lard, this is Carolyn. Good morning to you. I need to talk to you about your U.S. subsidiary, Transamerica. When we last spoke to you, I believe that was mid-November, you were pretty sanguine about the new president, the old/new president coming in. Now he's been in office for roughly a month and really making a lot of headlines on a daily basis, maybe on a minute and hourly basis. What do you see as the biggest impact on your business in the U.S.?
Well, it's quite early days to see what the Trump administration will bring to domestic policy in the U.S. However, I think the expectations are quite high that the Trump administration is really trying to maintain the strong economic growth path that the U.S. economy is on, and that, of course, is conducive to our kind of business. But it's too early days to look at the particular policies coming out for the U.S. economy as President Trump is assembling his team and have them confirmed by the Senate.
I want to talk to you about the UK economy as well, because you've been one of the cornerstone investors for the so-called British Partnership for Growth. Now, we've had more visibility. We've had a little bit more time for the new Labour government to do its work, but it's been very tough. The economic outlook, that looks very, very shaky. Are you disappointed by the overall headlines that are coming out of this government?
Well, let's say the government has a number of plans that they've announced, for instance, a pension review, which we welcome. By the way, indeed, we are one of the big proponents of the Mansion House intentions of the UK government to allow for more allocation of pension money into the UK economy, and specifically also in equities in the UK economy. We think that is good. It provides good diversification for clients. Now, the overall economy in the UK obviously is subdued, and we know that. The good news for our business is that we were able to double our retirement plan business sales this year in the UK, and we're making good progress there, while the advisor platform that we have is still in turnaround, as we have announced at our capital markets teach-in on the UK business in June of last year. But overall, I mean, the economy in the UK is, let's say, still subdued, as we all know, and we are supportive of, let's say, the pension review that the government is aiming to do in phase 1 has now been done. Phase 2 they need to do. And of course, we are a proponent of investing more of that pension money into the UK economy.
Talk to us about what reforms you see happening that are going to improve European capital markets, that are going to improve pension sales and unleash growth in Europe rather than just those other jurisdictions we spoke about as well. Europe needs to get really galvanised and move quickly. Are you seeing it happening?
I think there is a huge opportunity for Europe, quite frankly. It is a trading bloc with 450 million consumers. So provided that Europe uses this moment to have, let's say, a big step up in the integration of Europe, to closing the capital markets union and to finishing that project, which takes way too long, and to, let's say, implement the Draghi report initiatives, which I think would be very helpful for the overall competitiveness in Europe. I think that Europe will have, when it comes out to the other side, has a very strong opportunity in front of it. But it has to really now act, and we all awaiting what our leaders in Europe are going to do.
And just for our viewers who aren't aware, Lard, who's holding it back? I mean, we talked about CMU for the last decade.
Yeah. I think this is a number of countries that really need to step over themselves to make sure that this capital market union in Europe really is being finished and becomes a reality that will all be very conducive to the European Union economy and will increase the competitiveness of Europe. Will help to increase it.
Yeah, maybe a country that may or may not have an election in the next couple of days needs to get on board as well. Lard, lovely to see you, sir. Thank you very much indeed for that. Lard Friese, who is the CEO of Aegon. So many big issues and so many big CEOs today. Airbus has delivered on its 2024 guidance in what it called a testing year for the company, posting a 6% annual increase in full-year consolidated revenues to just over 69 billion euros, whilst incurring a 1.3 billion euro hit from its space program. The plane maker is targeting around 820 commercial aircraft deliveries this year. That's up from 766 last year.
Thank you for listening to Squawk Box Europe Express.
For more market-moving news, you can head to CNBC.com.
Or join us again on the show with Steve Sedgwick, Karen Cho, and myself, Arabile Kumete, weekdays on CNBC.